You are now tuned in to the PPC podcast. Subscribe now for more exclusive content.
All right, here we are. So, PPC podcast. This is episode 2. My name is Kobe Nyako.
And I am Matt Marsh.
And yeah, we're going to continue on from our conversation last month. I'm going to try and sit down with Matt after every bank rate decision. Yes, Portsmouth is what we're focusing on because this is where we are, this is where we operate. However, the information and the things we talk about in this podcast can be applied to wherever you are in any city or town across the UK and probably extends across the world as well, depending on the conversations we get into. So main thing, like, comment, subscribe and share. We're just sort of trying to make a community feel about this and get people's opinions and, you know, share understanding amongst people when it comes to property. So I'm going to go straight in. First thing I want to talk about is property prices in the local Portsmouth market. Now, this information I'm about to tell you can be found on the HM Registry House Price Index. So if you were to look into that through Google, and then do some digging and research, you can find out exactly what's going on where you are, wherever you are in the UK. So last month we touched on the property inflation year of 2022, which comes off the back of government lending during COVID and the stamp duty break after the COVID lockdown. So in Portsmouth, average property prices increased month by month in 2022, which on record hasn't happened in 30 years plus. The average price of property increased by 11.1% in that 1 year, and the average time to sell was 35 days. Now, since December 2022, average house prices in Portsmouth have dropped by around 7.6%, and the average time to sell a property nationwide is around 60 days. That's information I'm getting from Rightmove. So, that being the case, selling property in this market is proven to be quite tricky. A lot of estate agents or whoever's selling your property might be going off sold comparisons of 2022, especially where that's quite recent. However, in this market, especially with things like the cost of living, owner-occupier costs, mortgage rates, that kind of thing, properties aren't being sold at those prices anymore. So my question to Matt is, in this market, what is a realistic way to price a property when selling?
Okay, there's basically two things to consider in that. And obviously the 2022 rise, why did it rise so much in 2022? And then when we come up to how they value properties now and how that then works out. So the spike in 2022, COVID obviously kicked in 2020, rumbled on through to 2021. A lot of people who wanted to naturally move were halted. They couldn't do it. Mortgages were not being worked, furloughed, not even being able to view properties, so didn't know what their future looked like. So those people that would have naturally moved anyway couldn't. So now those people were just being staggered until, say, 2022, when the market opened back up. Government has now lent a load of money on all these various different schemes through furlough and everything else. So they've decided to try and stimulate the economy. We need some incentives, and one of which was the stamp duty break. And the reason why the speed was so quick is because the property would go on the market. The demand was so huge because you've got this backlog of people waiting to buy. Now they know their future's a little bit more certain. Then there was the rush to beat the stamp duty break. And we had people buying houses way over what they were worth, just because the demand was so high. So that artificially increased what houses were worth. Then all of a sudden you now lose that like backlog of buyers, and you've removed the stamp duty break. So if it was more akin, if you were to look at what the prices were pre-COVID and what they are today, there would probably still be a little bit of an increase if you took out the anomaly of 2022 because of those increases.
Of course, yeah.
So I do think if you were to measure the house prices more naturally, that would probably give you a better indication of what's fair for your property now. COVID was a real thing, unfortunately, that impacted us a lot, but the fallout of that continues. So the second thing is how do you value properties? Well, most people who will be buying a property will be buying with a mortgage. And if they're buying with a mortgage, it doesn't matter how much they want to bid for it, because if the mortgage valuation doesn't come back correct, then it's going to scupper the process. A mortgage valuer will normally use the comparables within quarter to up to half a mile of where that property is, and they will go back no more than 6 months, and they will only base it upon sold property data, not what's on the market and not what it was on the market for when it sold. They want to know, well, what sale price did it achieve? Because the point of a mortgage valuer when they're going out is to make sure from the lender's point of view, well, if this person doesn't pay, what are we likely to get for it? And because they're working on a risk basis, they want to make sure that they're keeping it on not the lower side, but they want to be the more conservative side of that valuation. And the next thing to add to that is nobody likes to think that their house price has dropped.
Of course.
Because over the since the credit crunch, about 2011, house prices reached back to it before the pre-crunch period. And then they just continued to rise. If we look at house prices all over that period, it's gone up and up and up and up. So we're not used to seeing house prices drop. So I think a part of it is the egotistical, my house is worth this much. And if we're being honest as well, there's a lot of agents out there that just want to win the business. So if you're Joe Bloggs and you don't know anything and you're thinking, I just want to know what my house is worth, then an agent, 3 agents, 4 agents, and if you're a less professional agent, let's say, and you're just going, well, your house is worth £1 million, and they'll go, oh, wow, if this guy can get me this much, then I'll go with this guy. But the truth of the matter is, as long as the basics are the photos and the write-up and it's put in all the right places, in the main step part, they will be doing invariably the same thing. It depends then on their service and everything else along that, which will differentiate agent to agent. But the price that they should be valuing on should all be around the same. But if you've got one agent saying they're going to get you 25 grand more than somebody else, then that's very tempting. Your expectations then been set. And in a hard market where the agents are struggling to get as many properties on the market, what they're going to do is they're going to try and suggest that your house is worth that little bit more, so you sign up with them.
Of course.
You're then tied into a long contract, and then they can manage you down. Say, oh, we're not really getting much interest in that. We need to reduce. And then you can't really then say to them, well, you said it would be worth 400, and now you're asking me to drop to 375. They say, well, there's not been that much interest, but there's not, well, they can't just go anywhere else because they're stuck into a 12, 20-week contract. I think also anybody that's bought recently will also be thinking, well, if they bought around the peak, 2021, 2022, spent money on improving their property, when costs were a lot higher, what they would think is, I bought at here when the house prices were peak. I spent way more than I expected because the materials and labour costs were a lot more. But the demand for houses has dropped. We would normally think, well, if I bought for 300 and I've spent 50 grand on it, I want at least 350 out. But the truth of the matter is, you're actually going to get less than that. But that people don't want to feel like they've lost out. And I think that realism needs to kick back in and then work that back out. So in a nutshell, modern day valuers will work on the basis of comparables, normally 3, and obviously not going to compare a 4-bedroom house with a 2-bedroom flat. It needs to be like for like properties within a quarter to half a mile within the last 6 months, and that's how they're going to ultimately arrive at the valuation. I think if agents were a little bit more careful about how they delivered, they'd probably find that the time it takes to sell would shorten, and they would achieve more like the asking price that they're looking for. Although that said, it's very much a buyer's market at the moment 100%. Rather than a seller's market. And there are, because rates are higher than where they were 2 years ago when you could still buy mortgages at 1%, mortgages are now 4%. Just to put that into context, for every 1% that the rate went up, it was costing, I think it was about 80 quid in interest. So if we imagine that per £100,000 borrowed. So if I was borrowing £100,000 just the interest at 1%, 85, 88 quid, something like that. If I'm now borrowing that same 100,000 at 4%, it's costing me a lot more. Yeah, it's cost me 320 quid now. So that's a real cost.
That's a proper jump.
Yeah, and that's bigger than the cost of the utility bills going up and things like that. It's a real. So all of a sudden, people who could have comfortably have bought I've got people at the moment that are getting mortgages agreed for say 300, 400,000. Then when they see the mortgage payment, they're like, I don't want to pay that. Yeah. That's too much. I can imagine. So yeah, whereas 2 years ago they would have gone, I can afford that. So now it's the actual rate that's also meaning that there's less buyers in the market too. So there's a number of variables that all contribute to the slower timescales, less buyers out there, and and as a result, the lowering prices we're seeing.
Yeah, that makes a lot of sense. Because at the moment, I think just me networking and speaking to people who are trying to sell their property, it seems to be a big struggle at the moment. And I think there's quite a few people who've been tied into those deals where initially, the agents probably said to them, look, we can get this amount for your property. And then 6 weeks later, the property still hasn't sold. They're going to have to reduce it, and then it just goes on and on and on.
Yeah.
And obviously, I know there's a lot of creative strategies out there now that people are starting to go into, which is a conversation for another day. But no, a lot of what you've said has made a lot of sense. Just to put that into context as well, where we're at in terms of properties being sold. So in Portsmouth specifically, average property sales volume in 2022 was 251. So on average, every month, 251 properties being sold. Now, the year to July 2024, it's 145. So that's a 42% difference. So that's the market now, and this is within 2 years. Considering everything that's happened with inflation and the bank rate and everything. So it's just things to take into consideration, especially if you're trying to sell a property at the moment, for whatever reason that may be.
Yeah.
Okay, so moving on, and I'm sure this will sort of like come back into the conversation in some kind of way. The bank rate has been maintained at 5% following an 8-1 vote in favour to maintain.
Yeah.
So one person wanted the bank rate to drop to 4.75%. The other 8 all voted to maintain it where it is.
Yeah.
So the most significant statement from the MPC report, which I read every month, is that UK bank rate expectations implied by market pricing suggested that the next 0.25% cut would occur in November.
Yep.
Now, from my understanding, I believe the next bank rate decision is on November 9th. So this is the November that they're talking about. From a mortgage broker standpoint, what are your thoughts on this?
I'm seeing a lot of lenders at the moment reduce their rates. They're almost getting into not a rate war as such, but now that we've seen a fair few mortgages drop below 4%, on that, it's easy to get hooked by my friend got this rate, why aren't I getting it? It does depend on the size of your deposit. The bigger the deposit, the better the rates and terms you're going to get, etc. I think that the lenders have gone, well, this seems to be good news. Let's ride the wave of the good news and let's price competitively so we can start lending more money. So I think they're kind of setting their stall up. This happened in reverse. When the rates went up, when the Bank of England base rate announced that the rate went from, say, 1.25 to 1.75 and then went up from there and there, the lenders went, our rates are now 3.5%, 4% straight off the bat.
Wow.
And there was a big increase. And they were like, but the base rate hasn't increased because they forecast that that's where it was headed. Actually went beyond that. But that's where they initially went. So what the lenders are doing is this in reverse. So they're going, well, we think it's going to fall around here. So it's going to get ahead of it because it's good for business because people will then start borrowing. Of course. And that's what they want to try and encourage. So I think that the pricing that we're seeing at the moment is probably the goods for the long term. And it's not so much 5-year fixed deals that I'm worried about because I think they're generally priced quite well at the moment. They're high threes, about 3.8, some of them. And I think it's more so the 2-year deals I want to see come down into the fold, just purely because it adds a bit more parity at the moment, because there is that bit more of uncertainty over the next couple of years. The lenders still are pricing their 2-year deals higher than their 5-year deals, just because they don't really know. We haven't quite settled into it yet. If we think about it from if you took it over time, I think the rates went up and they've only just steadied. And it's only just dropped. So there's a bit of a way to go yet. So they're going, well, this is still early in the is this good phase. So they want that to be steady and maintained. I generally think that the mortgage rate drop is encouraging. I think if everything is even, and there's no more pandemics, there's no more warfare, there's no more meltdowns and things like that. There's lots and lots of things that this needs to be variable.
Yeah.
But as long as that stays steady, then the base rate will hopefully climb down to around 3.5%, I would like to think. But that's going to take about 18 months. It has to be slow and steady.
Okay.
So, yeah, but I think that the rates we're being offered from the banks are probably not going to change massively once the second base rate drop's been announced, and then they just feel that level of certainty. I don't think it's going to go much below, if anything, below 3.5%, because what you don't want to do is create another problem by going with the rates too low again. That's where I feel that we are. I think it's sensible now.
So have you noticed since the last bank rate cut, have you noticed any significant offers within the mortgage market?
I do think something that's really encouraging, well, as long as it's being sensible, is I've noticed a lot of lenders actually beginning to increase the affordability margins. So whereas where they would normally lend, say, 4.5 times joint income, backed by an affordability model in the background, it can't just be 4.5 times income. So, for instance, if I earn 50 grand a year and I did 4.5 times income, but I've got a bank loan, a credit card, and this, that, and the other all going out, then, but I'm earning 40,000, I've got none of that, I could actually be better off on the 40 grand. So the affordability model still needs to work with income multiples. So it's easy just to get sucked in by, they said that they would do this, or some of the lenders now saying they'll lend 5.5 or even 6 on one or two of the lenders now offering, which now really helps open that out to new lenders, combined with the lower rates that are now being offered too. So that's encouraging. The news and the criteria is encouraging, but it just means that lenders are still going to be relatively careful on what they're lending. What they don't want to do is go back pre-2008 and lend money that is risky. They don't want to have a risky book. They want to be safe. They've had a lot of uncertainty. As long as the money looks good, then we're okay. But I think that the other thing that's really come out of the woodwork more so, and we're finding a lot more inquiries about now, is more specialist finance. So that's some secured loans, that's some bridging finance, that's some development finance, this kind of thing, because we're beginning to also see buy-to-let come back a little bit. Not a lot, but it's coming back a bit, because the criteria around it is getting easier. The stress rates are getting easier. And the lenders are now working on, so it becomes easier to get those deals. It's just now whether or not it's making money for people.
Okay. I've just got my head spun around 2 or 3 questions. So, let me start off with this. So, if they were to cut the rate in November, I know you've just said it's probably going to take a good 18 months for things to really settle down to where they need to be. However, if they did decide to drop the bank rate, could you make any predictions on what might happen within the mortgage market?
In my general thought is just good feeling. It'll be a case of people would then be wondering whether or not that would be passed on. I think the honest answer to that is it already has. The forecast is that they're expecting it, so they've already priced accordingly. So I don't think, in real terms, I don't think there'll be much change. I think that the rates will be about the same as what we're seeing now. It's just more encouraging to the market, and it will encourage more people to be thinking this feels like a safer time to get on board.
All right. So from that, let's speak about inflation. So inflation is still making its way towards the Bank of England's sustainable 2% target. Not quite there yet, 2.2%. But the main thing that they've stressed is that they want to make it sustainable. They don't just want to get there and then, is floating up or anything like that. They want to try and sustain that 2%. However, CPIH, so there's different measures of inflation. You've got CPI.
Subscribe now for more exclusive content.
Index, I believe.
Yep.
And then you've got the Consumer Price Index, which also takes into account owner-occupiers' costs. So that's the CPIH. They call it the most comprehensive measure of inflation, according to the Bank of England. But this illustrates, at the moment, the lasting effects of inflation. So owner-occupier costs, which is its own thing entirely, which is the cost associated with owning, maintaining and living in one's home. So that's mortgages, renovation costs, estate agent fees, all these kinds of things. At the moment is at an all-time high of 7.1%. So it's never been this high before. Now this also affects rents, which are up 11% in the 6 months leading to August 2024 in Portsmouth. That comes down to research I've done privately. Nationwide, rent has reported to increase by around 30% in the last 4 years. Yeah, so this is where we're at. There's a real crisis around rents at the moment, but it's off the back of what's going on with the mortgage rates and everything that's sort of like gone up, owner-occupier costs. So let me start here. What are the trends that you're noticing in the financial health of your clients?
I think we probably were getting towards COVID. We had more of a throwaway society. I want something now. Didn't really matter. Just get it on tick. Borrowing was very easy because it was very cheap. I think people now think twice before they get those instant purchases. Maybe they aren't getting the swaggy car on HP. Maybe they're thinking, maybe I don't need to upgrade my phone. I'll just get a one that works for me. I'll stay on it. I think people are just quietly thinking, okay, do I need to spend this? Do I need to spend that? And they're less frivolous, I would probably suggest. I don't see, I get to nose at people's bank statements. So, if you look at mine, it's like McDonald's, KFC, Subway, Fat Fighters. But it's one of those where I think that people's spending has just naturally been tightened. And I don't know if that's come through people being much more careful about what they're spending their money on. I just think naturally they know that their purse strings are tighter. I think that younger generation are staying home longer. I think that they're probably doing that so they can avoid paying such high rents, because I think the rent problem causes you get more multi-generational living. So people thinking about, no, I'm going to stay home with mum and dad, or even, as we've seen, the explosion of HMOs, because it's now cheaper for me to live in a place where all I pay is my room rate, and that's it, to keep my costs down.
Everything's there.
That's it. I think it's a change in how people live now, rather than necessarily just the finances itself, and less about needing to worry about, just look at social media. You see people upcycling stuff now, and it's more trendy to, can I say trendy? I'm 46 years old.
Of course you can.
But yeah.
Mate, that's just young energy. That's all that is. That's young energy, man. You got to embrace that.
That's it. It's one of them things where I think it's more, people are more looking at the bargains they're getting, how savvy they are when they're shopping. And I think that people are looking at that going, do you know what, that's smart. How many people buy stuff off of TikTok Shop? Or get stuff off of the other places as well, where you can get it all now nice and low cost. So I think that people's costs and level of frivolity has gone down, and I think that that's tied into one eye on the agenda of, am I going to buy? I think we've always asked questions for as long as I've been doing it, in the 20 odd plus years that I've been doing it. People have always said, how a first time buyer is going to get on the market. That's been a forever question. That's not just now.
No,
it feels even harder now. But it's been that question. And I think that with those changes...
Would you say since 2008? Potentially.
I would say, well, up to 2008, you could do the 125% mortgage.
Yeah,
You didn't
yeah,
even need a
yeah.
deposit. They can give you money to do it.
Yeah.
It's like self-cert. I'm a cleaner. 50 grand a year. Yeah, absolutely. It's
Yeah.
like it's crazy.
It's crazy.
But 2008, I do think that burst the bubble a bit. I don't think rents are helping, but I understand why some of the rents are doing that. But I do think that we've seen some offload.
Okay.
So I think that the cost of living, it's been an adjustment for us all.
Okay. I've just done that. I don't know if this is going to affect the audio, but I just clocked that all the other mics are on.
Yeah.
Fingers crossed. There's always something. One thing I've learned. Okay. So considering the cost of living and the financial health of homeowners, are these rates in any way more favourable in this market? The rates that we're at the moment.
The rates are good at the moment. They don't feel good because we're used to 1%. But they're good for where they should be. Speaking across a broader term than since 2009 when they decided to drop the rates down to 1% and lower. I generally, as we say, the base rate historically has always been around 4.5%, 5%, and it's at 5% right now. We're aiming that it's going to look like 3.5%, which I think would be a very good rate,
100%.
Historically speaking.
Definitely.
And I think that it is the new normal, and I think that's what we should be looking for. Because again, one of the things that really hurt a lot of people, which we don't talk about, and it's not my bag, but I understand it, is the savings and investments and where people could put their money. And what people did then is where they didn't know where to put their money before, because they were getting next to nothing on savings and investments, they started looking at maybe more riskier pursuits or sticking money in property, because that got them a lot more than the piddly amount that they were getting on the investments that they were looking at before. Now, with the rate being a little bit more fair, spread across savings and investments and mortgages, because we're looking selfishly from a mortgage point of view, it starts to then give people a bit more assurance about that their pension pot's going to be better and that their investments are going to be better and things like that. I think mortgage rates, again, it's the forever question of do I do a 2-year rate, do I do a 5-year rate, do I do a tracker, what to do. I'll very quickly dispel the tracker mortgage very quickly. So a tracker mortgage is obviously one that tracks the Bank of England base rate. So if the base rate gets reduced, it falls in line immediately by the same amount. But the problem is with that, so if I just take an average comparison on a 2-year fixed at the moment would probably be about 4.2, 4.3%. 5-year fixed, probably just under 4%. But a tracker would track, say, at best, 0.25% over the base rate.
Wow.
Okay. So that would mean I'd pay today 5.25%. Okay. So the idea might be, well, if I go with a tracker mortgage, rates are coming down, surely that's a good thing to do. Well, that rate's got to come down at least, let's say, if it's an average of 0.25%. And if we just do some very bogus maths on they cut it, keep it, cut it, keep it, cut it, keep it, then and they only do 8 announcements a year. That's a year, and you've had 4 drops. So now it's come down to 4.25. So for a whole year, you've been paying more than that 2-year fixed rate, and you are so it actually hasn't worked out better, even though you've benefited from the drops. And then you would need it then to continue to drop if the base rate does drop. Beyond that, and then you might have got a smidgen of a difference better in the second year, but you might not get anything at all, assuming that you've got none of those catastrophes we spoke about earlier. So you go for the 2-year deal or the 5-year deal. Now I say personally it's got to be based upon your own personal not belief in what's going to happen with the rates. I think that should be your secondary thought. I think the first and primary should be, does this fit my lifestyle? So number one, if I'm thinking about, I've just bought a little flat, it's my first place, I'm going to get in there, I don't see myself staying here long term, my wages might go up, my circumstances might change, I might start a family, all of these things. So there's lots of things that could do with flex. A 2-year fix will mean a 2-year tie-in, a 5-year fix will mean a 5-year tie-in. So it means if I want to leave either of them early, there will be early repayment charges. Now you can move mortgages from one home to the other, porting as we call it, and there are other features you can do. However, let's say I'm going to pick on NatWest. I've gone, right, I've done my 5-year fix with NatWest because that was the best deal at the time. I now want to move to get a bigger place, but NatWest won't lend me the amount that I need. But Halifax will. So I then take my, so I can't move because NatWest won't lend it to me unless I now pay a penalty to come out of NatWest to then go with Halifax, which has made the whole thing more expensive. Whereas if I did the 2-year deal, I could be thinking, well, I can time that so it comes up to the end of my 2-year deal, then move. I haven't got the early repayment charges, so I might have potentially got a little bit of a more higher deal in the early day stages, but it's allowed me then to have the freedom to do what I need to do when I need to do it. So make it for your lifestyle. If you feel like I'm not going anywhere, we're all settled here, I can see myself being here for the long term, say a 5-year fix will be fine, but just don't get all caught up in, do you know what?
I missed out on this.
It's because you don't know, and you will only know with hindsight, because if the rates did drop, you'll be going, why did you recommend a 5-year fix? I wish I was on that now. However, if they started to drop, then something happens in the world, pandemic, financial meltdown, the dollar collapses, the yen, whatever. Then all of a sudden those rates dipped and then went up. You'd be thinking, thank God for that. You'll only know with hindsight. Think about the analogy I like is 10 Skittles in a bowl. One of them's poisonous. Are you going to take a Skittle? And it's like, I don't know which one it is. So the likelihood is, are you prepared to take the risk? And if you think to yourself, no, I can afford that, that works for me, do it. And if you think, do you know what, given it, based upon the level of risk I feel that I'm facing, I'd rather just do the 2 and gamble on where it's going to be. But just also be prepared that if it doesn't pan out, it could be more expensive.
No, that makes complete sense, and I think that's a great way to look at it. Analysing your own situation. Another thing I wanted to bring up actually that you slightly touched on is the generational thing. I feel like me being in my early 30s, looking at majority of people around me who I grew up with, renting seems to be the new norm. Yes, I'll have a few friends that have got mortgages, but renting seems to be the thing that everyone's sort of going towards, even if it comes down to wanting to start a family or just getting out of your parents' house, being in your 30s and that sort of thing. So rents right now, it being it inflating the way that it has, I know it's really having an effect on the cost of living just as much. And then now you've got things like, we're not going to get into it, but the renters' rights bill and everything that's coming up. I know for me, for my personal circumstance, I don't mind talking about it. We had a rent increase this year and we're about to go on to another one. So yeah, there's loads of different things happening, and it all stems from what's going on in the economy. Hence why these conversations are really, really important.
Regarding renters, I do think, my personal opinion is, I think we've reached a peak. I do think there'll probably be a 12-month lag on renters actually seeing, I'm not going to say a reduction in their rent. I'd like them to get a reduction in their rent.
I can't see it.
But I do think that what's going to end up happening, as I've seen with a couple already, is I do think that there is a ceiling now where you can go, right, that 3-bedroom, we're going to charge you £2,500 to rent that. And people are just not paying it. Because now somebody go, hang on, I'm struggling to rent, I'm going to lower that. I've even seen with some HMOs where it not been heard of before, you literally list it, they all rent out, and they kept on going, oh, we're getting this much, we may as well keep creeping the price up because it's clearly the demand for it. Now I'm beginning to hear, not all of them, they generally do still get all full, but they're beginning to go, oh, hang on a second, they haven't filled out as quickly as I thought they would do. So hang on, maybe I'm beginning to reach a threshold here. And I think part of that's because rates have peaked and now dropping. I think because buy-to-let, I don't think buy-to-let will ever make a comeback like it was when the rates were so low.
Of course.
I do think there is now a place back for buy-to-let. And I think part of the house price drop that we were talking about earlier is because buy-to-lets disappeared in 2023. Because rates went shooting up and then buy-to-lets became near on non-existent in 2023, other than, for the most part, people that were just switching rates. But I would suggest that now that's stress rates and everything else.
You are now tuned in to the PPC podcast.
And I do think that we'll probably find people becoming more sensible about what they're charging for rents. But unlike mortgage rates, I don't think they'll go down. I just think that they've probably capped.
Yeah, 100%. It'll be interesting to see the autumn statement and what they're sort of coming out with regards to the renters' rights bill and other things in that as well that affects the economy. All right, so this could go anywhere, but we'll see how we get on. So a wide range of factors will have various implications on the next decision in November. Including the government's first autumn statement, which is coming up October 30th. The Russia-Ukraine war still going on. The Israeli-Palestinian conflict is, that's still going on, and obviously things that have happened recently with the walkie-talkies and all that kind of stuff. So that's really going on. And the US election, following their 0.5% bank rate cut. I believe that's just happened. So a lot of things going on in the world. These factors can go on to affect energy prices, again, contributing to inflation, supply chain disruptions, especially around the Red Sea area, and investment sentiment, especially. I think we had a slight conversation in the last episode where you spoke about other countries looking here for investment. And I believe that's kind of changing, especially since COVID. Things have changed big time in terms of people pulling their money out of here. I know I don't want to get into this too much, but Russia, Ukraine, a lot of oligarchs and those kind of people had to leave the country, and that takes their investment as well. So there's a lot of stuff going on. Now, without getting too political, what are your thoughts around these sort of factors?
This is why I always say it's got to be about your personal circumstances rather than trying to second guess what's going to happen with the rates, because it's far too precarious to gamble on. The same banks and experts that were predicting and giving 5-year fixed rates in 2022 of 2%, you wouldn't get that now. But they predicted it, and they are far more knowledgeable than I am about what's happening in the rates. I do think that you've got to have an eye on it. Many moons ago, I'm not going to say the good old days because there was a load of bad stuff that happened too. I would say, but back in the olden days, before even my time, we had the UK made its own cars, provided its own fuel, made its own bread, milk, and everything else. Everything was done within the UK, pretty much. We relied on very little import. Then everything became cheap, made in Taiwan, fuel from Russia, and pipelines and things like that were all built on the cheap to supply us. They then supplied us. We cut away all of our own things. We closed down our plants, and everything else got shipped abroad because it was cheaper. Now all of a sudden, you're kind of held hostage by it. Because if they go, the cost of fuel has gone up, therefore the cost of our goods has gone up, and we have no choice but to pay it. Okay, so the cost of import becomes much more expensive. And unless we decided to go, do you know what, we're not going to buy that, and put a pause on everything for a good number of years where we rebuilt everything, which is going to cost a fortune, realistically that's not going to happen. So we're now a bit of a slave to it. So we are reliant on these things, and because we are now reliant on them, we are much more affected by what happens globally, and that's why it has so much of an impact on our interest rates, on our inflation, on our cost of goods, and all of those things. I think that it's almost like it's no longer become newsworthy, the Russia-Ukraine war, the Palestine war. And even though those same atrocities are going on right now, if not worse, there was the thing that I heard that there's been more bombs dropped on Palestine than the US territories like Pearl Harbor, London, France combined during World War II. And it's heavy.
That's crazy.
And you think that's happening right now, but it's not. It's become we've become so desensitized to it
100%.
that we don't. And then what we're not factoring in is, well, I won't get into the humanitarian side and what my feelings are on it, otherwise we'll be here all day. But from a monetary perspective, we have to understand that that could have an effect at what I pay for cars, fuel, goods, this, that and the other. But to put a positive spin on things, fuel is now very low.
Yeah.
Considerably, because we were paying nearly £2, and now it's down to like 1.33, something 1.35. It's nice and low now. Mortgage rates are coming down, not just here, but abroad as well, as we mentioned with the US. And trade is becoming freer. There's been more. Everybody's begun to settle with how we now live in a post-COVID society, which has had its benefits in regards to we've now learned how to be more efficient at how we do some things, and some things aren't so great, and we could probably do away with some of the COVID things that we did get involved in that I don't think are necessarily as productive. But I do think that we are in a very different society today than where we were pre-COVID. But I do think that there are some benefits that are coming out of it, but we've got to keep a weather eye on what's happening in and around us to know how that impacts everything.
All right, that was great because we didn't get too political. It didn't go too crazy. Nothing was going off in here. So, if anything, I think 40 minutes. That's a good time.
Yeah.
Is there anything else that you want to mention?
Just keep an eye on the October statement. Let's see what's going to happen. I do think you got to be careful. Like I say, with the renters' rights, I'm in no means looking after landlords. But I do think that there has to be balance. 100%. Sure. At the end of the day, again, if we go back to what we talked about earlier on mortgage rates, for every 100,000 they were borrowing, it was gone up 80 quid.
Yeah.
So if the mortgage that they're paying had gone up by, I don't know, 400 quid, for example, and they've only put your rent up by 50 quid, now all of a sudden you're not happy that it's gone up 50 quid or more. Now, typically, they should be capped to 5 to absolutely no more than 10% on the increase on what they're giving you on your rent. And that feels harsh. But when we actually think about, well, in real terms on their mortgage, they've been put up by that. Now, if they didn't pass it on, and then you've got to think, well, they're being squeezed. My landlord's being squeezed. And you might not care too much for your landlord. But then, whenever I need to get maintenance done on my property, is he going to do it on the cheap because they're being squeezed elsewhere? Or is he actually going to look after me because I look after him? Or is he going to be thinking, oh my God, it's another cost, it's another cost? And is he ultimately then going to go, do you know what, it's not worthwhile anymore, as many renters have seen, and then just sell it? Or do you want a distressed landlord that's the person that is responsible for the roof over your head, that then defaults on his mortgage, meaning you're now unsafe? So there always has to be a union, really, between the landlord and the tenant. We cannot go thinking it's the big bad landlord. Well, when the government's turning around and saying, well, we've taxed him on this, we've taxed him on that, we're charging him on this, we're making them go through these red tapes, and then they go, well, I don't want to be a landlord anymore, I'll sell it. And so we've got to be careful what we ask for. It can't just be us out with a begging bowl going, I want. It's got to be a case of what's good for me, what's good for the landlord, what balances out. So that's I worry when I see things like they want to scrap a landlord's rights to do X, Y, and Z. Likewise, I want to see rights for the tenant. It's got to be balanced.
There's got to be a balance, definitely. There's got to be harmony. And for me, I just think there always needs to be a good level of conversation between the tenant and the landlord, just in general, just on an everyday, day-to-day kind of thing. But all right, cool. We'll end it there. Thank you for joining us, guys. I hope you found that insightful. Just remember to like this video. The more you like it, the more people are going to view it. Comment as well. I will personally reply to your comments. Matt might as well. And anybody else that sort of like logs on. Maybe even cameraman as well. And we'll reply to your comments, man, and try and get a bit more of an understanding out there for people who don't get this information, because I can imagine it can be quite heavy. I'm just hoping that me and Matt having these sort of relaxed conversations allows you to pick it up in a subtle way, so when you're watching the news you can understand what they're saying behind all the headlines. and subscribe as well. We've got loads more content coming up in Portsmouth Property Connect in general. So subscribe. Like I said, me and Matt will be sitting down after every bank rate, having these kind of conversations, and then more to come from there. So thanks for sitting down with us, and we'll see you on the next episode.
Catch you later.